Good morning. Thanks for joining this conference and listen to the next panel. The next panel is called Global Capital Allocation in Chinese and American Securitized Products. We have a very distinguished panel here. Let me first briefly introduce myself. My name is Jian Hu. I'm a managing director at Moody's Investor Service. I manage new ratings of all corporate asset securitization and also supervise research for structured finance. So this is a very interesting panel to focus on a pretty unique but very exciting segment of the financial markets. Before we talk about some of these interesting characteristics of the market, we are going to first introduce the panel. So if I may ask each panelist to briefly introduce yourself. We are going to start going leftmost. Steve, please.
Thank you. My name is Steve Abrahams. I'm a senior managing director at Amherst Pierpont Securities. We are a broker-dealer in New York, and in May, the newest primary broker-dealer, and I manage the strategy group. We cover all traded U.S. fixed income markets, and most of my background for nearly 30 years has been in covering securitized markets in the U.S.
Good morning. My name is Alex Silverman. I'm a managing director at Natixis, the second largest French banking group in France. I run the global CLO business for Natixis on the banking side. We have been top 10 underwriter in CLOs, both broadly syndicated and middle market, for the last 3 to 4 years. I've been in the industry for doing CLOs for more than 20 years, and happy to be here.
Hi, my name is Raymond Chen. I'm the vice chairman for X Fintech, a financial technology firm providing securitization support in China. And I'm also an associate secretary general for China Asset-Backed Securitization Forum 100. We are a partner with IMN to have an annual securitization meeting conference in China this March and this past March and next March. Myself was an old securitization banker with Greenwich Capital or Covia. Before I went back to China 17 years ago, I was with Citigroup, RBS or Covia, Barclays in Hong Kong, and has been quite familiar with the securitization industry in China.
Hi, I'm Winston Cheng. I work for S&P Global with the ratings agency side. I've been with S&P for about 20 years. I started first in the US, really focused on esoteric assets. Spent a good part of my time as a manager, focused on CLO market, CMBS, as well as the esoteric market as well. And then in the last couple years, I really transitioned to more of a global role. So I now focus as the head of analytics and research on both analytical developments that happen around the world and how that might affect our analytical processes, as well as working with a team of sector leads and other structured finance researchers to develop research around the world so that we can provide thought leadership and other analytical thoughts as we work together as a global team.
Thank you, everyone. As you can see that these are some of the most experienced veterans in the securitization market. Before we start our discussion on the markets, we have a few slides prepared. For people who are not familiar with the structured finance markets, you may wonder how large the market is, right? So here are some of the charts that I've prepared for different regions, US and Europe and Asia. And this is the dark, well, I don't know if it's dark everywhere, but let's say the bottom portion of the bars are the securitized product portion. And overall bars for each year in each chart, those are the overall bond market issuance. You can see that in the US, for example, but it's a very large bond market in the US, and securitization market is it's about 20-some% of that. So it's a small fraction of the overall market, but it's not that small. It's significant. But if you look at the Europe, very similar in terms of the share of securitized products as a total of the fixed income market. In Asia, the fraction is even smaller, but the market has been growing very fast. And also the total size, and we're going to see the China charts in terms of bond market. The total amount of bonds that are outstanding in the US and China are very similar now. So depending on how you measure it, people are saying China is has the largest bond market in the world, or second largest, depending on how you measure it. And we're going to get into that in terms of what's driving the market growth in the bond market. But the point of this slide is to show you that securitization market makes up a significant share of it, even though it's not the majority. Within the structured finance market, there are, and I think you heard it today in the morning keynote speaker from Mr. Phillips, who talked about agency markets versus non-agency market. So this chart shows you what government agencies, the roles they have played in the market. You can see that in the US, agency securitization actually plays a much more important role than the so-called private labeled or non-agency markets. And that's true basically in Europe. Well, Europe doesn't have the agency market, but it has a significant share contributed by the so-called cover bond issuance. In Asia, also the agency markets, that segment of the market is relatively minor. So I'm going to just pause here, and before we go to the future slides, let me just pause for a second and have some discussion on the overall market dynamics. So I'm going to ask Stephen to talk about, we just talked about agency versus non-agency, the RMBS market, in the overall market growth context. How do you see the market going, and what's driving the growth or the diverging trends in these different segments of the markets?
Thanks, Gian. Well, in the U.S., it's still important to remember that the agency mortgage market is probably the dominant source of securitized product. And securitization really got its start in that asset class as well. There's about $6 trillion of it outstanding, I believe someplace in the neighborhood of 1.25 to 1.5 trillion will get issued again this year, mainly driven by the refinancing of existing loans and mortgage pools. And that creates the benchmark for a lot of other parts of the U.S. Securitized market. If you went back, at this point, 14 or 15 years, you would have seen a very different picture. At that point, the non-agency mortgage market was capturing at least half of all securitization. And that was the real heyday of subprime, Alt-A, and other forms of lending to borrowers that couldn't necessarily get mortgage money in the agency market. Then a little thing happened called the 2008 financial crisis, which I think exposed some of the fragile underpinnings of private securitization. And the market rapidly fell off. Issuance essentially dropped to zero immediately afterwards. In the last couple of years, issuance of private MBS has come back. It certainly has not rebounded to the level that we saw in the mid-2000s. But at this point, the balance of private MBS, starting, I believe it was in 2018 actually, began moving up by a slight amount. The issuance of new MBS started to outweigh the pay down of existing private MBS. And this year we've seen a pretty interesting mix of products come to market. There are deals backed by reperforming mortgage loans. A number of larger banks have issued securitizations backed by prime jumbo loans. We've seen various forms of non-QM loans come to market, and there's continuing to be very interesting experimentation with forms of securitization and risk transfer. And so I think there's still a lot of vitality in that market, and we're likely to continue seeing at least good marginal growth and experimentation over the next couple of years as well.
So what do you think that are the biggest changes to the U.S. RMBS market since the financial crisis? Like what are the major changes, or maybe even the obstacles for that market to grow to a level that was last seen before the crisis?
Well, a lot of the lending pre-crisis to weaker borrowers is basically now been is now being done by FHA and VA shelves. So that shelf is now catering to borrowers that really don't have enough equity to afford a traditional 20% down payment. So FHA has taken up a significant amount of slack there. The other thing that obviously has happened, two other important things, has been the implementation of non-QM lending rules, which has eliminated a fair amount of some of the riskier lending that was occurring pre-crisis, including IO loans or various forms of subprime lending. So non-QM has had a very significant effect and has really bounded the kind of lending that can be done in the primary market. And then the other thing that's been important has been the implementation of rules requiring risk retention. So the sponsors of various private securitizations can no longer originate and sell, at least not completely. They still have to eat their own cooking, and so they retain risk, and that creates an incentive for both the originators and the sponsor of securitization to create lending and create loans that they believe are fundamentally sound credits, and that's a pretty significant change. In terms of getting back to where we were pre-crisis, honestly, I think that's going to be a pretty tough bar, because the agency market becomes an extremely efficient way of financing mortgage lending, and it's extremely difficult for the private markets to compete. So the private markets basically have to start where bank and agency lending stop. There is some chance that at the beginning of 2021, some of the non-QM rules may lapse that at this point favor the use of Fannie and Freddie to securitize some forms of non-QM lending. But if that does not lapse, if there are efforts made to keep that in place, I think the agency market, at least in mortgage space, you know, that's going to be the big show going forward.
Thanks. Winston, do you have anything to add?
Yeah, I wanted to talk a little bit about, we did a recent paper in September of this year. We called it, it's part of a series of papers we've written related to when the cycle turns. I think it's kind of apropos. We're 10 plus years now in a positive cycle post the financial crisis. You know, when we travel and see investors and other market participants, you know, one of the big questions for us is, are we going to be facing a similar challenge that we faced in the financial crisis for anything that we're facing going forward? Obviously, we're not perfect prognosticators. We never would say that absolutely not. But I think there are certain dynamics a lot of which have been talked about in terms of the shape of the current RMBS market, but there are certain areas that there's some challenges. And so in our paper, we talked a little bit about a hypothetical stress test. Not as severe as what we saw during the financial crisis, but we thought things such as a slowdown in the US, hypothetically, where maybe you might have a GDP drop of like 1%, Europe suffering a little bit of negative GDP, maybe a blip in the unemployment. We assumed maybe the US would go up to 6% unemployment. Clearly not as severe as the financial crisis, where you would have seen a 3% GDP drop as well as 10% unemployment. But we thought it'd be a useful exercise to publish, well, what would happen globally to all the different sectors with regards to that kind of stress based on our ratings. And so when we did it, it was really broken down into the following punchline. At the end of the day, the vast majority of the impact we believe are downgrade risk, mostly centered around non-investment grade, perhaps in certain sectors reaching as high as low investment grade, probably BBB. The default risk is almost all going to be centered, in our opinion, probably at that non-investment grade side versus reaching up higher. And I think that's a very different picture than what we had seen prior to the financial crisis. And I think this is an interesting opportunity. There's probably a lot of points that you could go through that are driving some of it, but there's certainly some areas that we'll probably end up speaking a little further on, such as the CLO market, which is showing maybe some degree of a little more asset bubble formation, maybe in the minds of various market participants versus where it was pre-crisis.
Thank you. Yeah, we certainly will have to spend some time on the CLO market, leveraged loan market, how that's trending and any concerns. But before we switch to a different asset class, I do know, in fact, there was a question asked during the keynote speech about the government's role in developing the mortgage-backed securities or mortgage loan market. I know that has been asked, debated quite intensively in China, whether we in China needs some sort of a Fannie and a Freddie. So I'm going to try to see if we can ask that same question here, and any panelists feel free to chime in. But Stephen and Raymond, look, what do you think? Should China have Fannie, Freddie, or FHA, whatever those government agencies, to help support the mortgage loan market in China? Any thoughts, any views, good or bad?
This discussion has been in China ever since I went back to China like 17 years ago. But I think if you look at more macro level, China's government is in the financial industry a lot. They're in everywhere. So it's not really you want to have a separate FHA or FNA. If anything, I would think the Chinese government, the interference, the interaction with the market, it's since day one, and it's always there. And why their function is indispensable, especially in China's political economic system. But on the other hand, I think the Chinese government should go back, back a little bit. Should let the market force to play more role instead of the other way around. So we probably have a different problem here. Now, again, everybody has a different opinion on that. But for my own perception, it's not too little. The government try to get into the market is a little bit too much in certain circumstances.
Gee, I would not really know how to start opining on whether it would be good for China. I'll tell you that in the U.S., the agency role, the Fannie, Freddie, Ginnie role, I would say has net been positive for the housing market. It's created in general a lot of access to residential credit that may have been much more difficult in the absence of the GSEs. It's created a lot of uniformity, at least you look at the way that mortgage-backed securities trade. At this point, the U.S. mortgage-backed securities market is probably the second most liquid securities market on the planet after the U.S. Treasury market. So that's kind of an extraordinary outcome for a form of lending that you realize ultimately puts money in the pockets of mom and pop all across the country. And it's just amazing at this point that capital from all around the world is drawn into that market in order to finance home ownership in the U.S. So that's probably been way beyond the expectations of the people who got the program started. There's probably a legitimate argument about whether that form of favorable treatment of housing is the right thing to do. Maybe it leads to overinvestment in housing. I'll leave that to the economists. But I'd say one thing that, I don't know, over the course of my career I've drawn is that once you start down that path, it's very hard to go back in the opposite direction. So you have to take that first step very carefully.
Yeah, I suppose comparing the markets and thinking about where China is for its mortgage market, and then on top of it, it's, you know, RMBS, residential mortgage-backed securities. And I think to both of the panelists here, I think on the one hand, it seems as if, at least last year, for example, RMBS was one of the biggest areas of growth. This year to date, in 2019, there's been a definite pullback. You know, part of it going maybe to the concern about additional speculation on property, and whether or not at the end of the day there's a comfort level with regards to the Chinese government's sense of where that market should be. Some of these questions really at the end of the day are somewhat politically oriented, i.e., what's the right level of affordability? What's the right level of home ownership we want within the populace? And then on top of it, there's some challenges as China grows from traditionally, a lot of the RMBS seems to be focused on the major cities, what we'd call probably the tier 1, tier 2 cities. And now it's expanded to additional issuance where you're focusing on smaller and mid-sized banks that may be lending to regional pockets of risk that you may not have seen before. So there's an interesting evolution that's going on within the Chinese market for where it is today. But currently, I also would agree, it feels as if the underwriting and how the government interplay with regards to the regulators look at it and may set certain rules or standards as to what they have to abide by, whether it's by city, with loan to value, or certain other elements that affect how the underwriting actually occurs. So it's an interesting perspective, a more managed approach than what we would see in the US, but also I think that's currently the approach that seems to be on the table.
Yeah, very interesting. We're going to come back to the Chinese RMBS and so on a bit later. So let's just switch to other products, and let me see if I can get the slides work. Okay, so another chart here is to show you the different sectors, the mixture of these sectors between CMBS, RMBS, CLOs, and ABS. You can see that the trend lines are quite different. Certainly, depending on, let's say if you look at left-hand side, by the way, it's hard for me to really read here, but the CLO market has really grown exponentially. 2017, 2018, I think that is the talk of many market participants, regulators, and the media, and we're going to talk about that, and then we'll ask Alex to share his insights. But also, if you look at RMBS overall, the market, this is private labeled, not including agency, issuance has come down. If you look at outstanding amount has come down very significantly. The ABS market actually has been growing. Their market consists of autos and equipment and other esoteric ABS and so on. So, so that is the dynamics in terms of the mixture of assets in the U.S. market. So in terms of CLOs, which is the kind of next big topic for us, CLOs, this chart shows you the overall size of the leveraged loan market. As of the end of 2018, it has exceeded 1.1 or 1.2 trillion, and that has, drawn a lot of concerns or interest. And CLOs contribute more than 50% of the funding to those leveraged loans. So now I'm going to ask Alex to talk about really what's happening, why the CLO market has grown so fast Is it going to continue growing, and are you concerned, and how should people think about this product?
Sure, thank you. The CLO market has been at a pretty healthy pace for the last 15 years. I think one of the reasons that the CLO market has grown, I think at the end of the day, the volume is tied to the underlying leveraged loan market, which is mainly issuers, U.S. issuers that are BB and lower rated. CLOs mostly are constructed of single B rated loans. These are senior secured loans of higher leverage companies. And we can see from the light blue line, the volume has increased up to outstanding close to 1.2 billion of what we call broadly syndicated leverage loans. What's important to emphasize is it's been an institutional market, so a lot of the lenders are institutional lenders. CLOs have been around 50 to 60% of that market, and I think the growth of CLOs has been correlated to the growth of the leveraged loan market. I think in general, when you look at corporates, given where rates are and the rate environment, and also the growth that we had in the last, since really the financial crisis, the low rates have enabled companies essentially to borrow more, which is a source of concern for all of us across the industry, whether leverage is too high, and we can talk about it later on. But I think in general you've seen anywhere from 2 to 3% growth in the U.S. That has been leading the Western market. And I think, leveraged loans are an engine to the growth of those companies. The CLOs are 50 to 60% of the market. They enable those companies to finance that growth and borrow through the CLO market. It's interesting to talk about the population of investors in CLOs. Essentially, it's a mechanism of funneling money that is not necessarily, would not necessarily directly invest in those highly levered companies. The money would come from treasury desks of the large banks, whether it's US or Japanese or European institution, insurance companies, structured credit investors. They would not invest directly into those companies. I think the CLO securitization methodology is a mechanism to funnel that money and distribute it to various U.S. corporates.
Yeah, that's very interesting. So these vehicles that are providing funding to the real economy. In the U.S., a lot of companies are borrowing because of a low interest rate, and then these loans are packaged into CLOs, and that's one of the reasons why it's growing very fast. You mentioned the Japanese investors, international investors. That seems to be another important aspect of this market, is that this product has attracted a lot of international investors, including people from Greater China region. Would you like to comment on, why do you think these investors in the Greater China region are interested in it, and what are they looking for? Why are they interested in the product?
Sure. So prior to the crisis, I think what you saw in general, especially amongst U.S. and European banks, a lot of them invested directly in those companies, in those high-yield companies. Following the crisis, I think with the new regulations on banks and the requirement to hold more capital against lower-rated securities, a lot of banks, mainly U.S. and Japanese banks, have shifted their focus and are now investing through the CLOs. So instead of lending to a double B or single B company, it would be very costly from their own capital standpoint. They'd rather invest in the AAAs, primarily in the AAAs and AAs of the capital structure, and AAAs and AAs are generally speaking 65 to 70% of the CLO capital structure, and those would be AAA and AA securities. That way the bank will need to hold less capital against it. So I think it's a healthier way for banks in the US and around the world to invest in the higher levered corporate market. What we've seen from the large US banks have been investors, Wells Fargo, Citi, JP Morgan, CIO, etc. And Japan has been a big investor, so people in the news have been Norinchukin, Japan Post, and then smaller banks like Sony Bank, Mitsubishi, etc. We have seen the nice thing about a CLO, it gives you the option or kind of the menu to invest in the rating and the risk that you choose to invest. So what we've seen, treasuries of banks typically invest in AAAs and maybe AAs. As you go down to AA and single A, we see more insurance companies, and as you go down more to the BBB level, you see structured funds, and as you go down to the BB and equity, that's more structured funds and hedge funds and private equity shops. I think when it comes to Asia, we've seen some participants that have participated for a long time, namely Japan, Korea. Recently, we've seen insurance companies from Taiwan, for instance, invest in the asset class, mostly in the mezz and also some in the equity. And we've seen some participation of Asian investors with the source of the capital coming from China, mainly from Hong Kong. I think it's mainly offshore money, and that has been probably two-pronged. We had some AAAs that were invested with a source from China, and also the lower part of the capital structure of the equity. But that has been a small percentage and growing, but I think it's mainly subject to the capital restrictions. Mm-hmm. It's very difficult to invest directly in the U.S. market coming out of China. Mm-hmm.
Very interesting. I don't know if anyone wants to add to the discussion on a CLO product.
Maybe just from a risk perspective, since I am at the rating agency and at S&P, I need to chime in just a little bit. I think, what I think we're comfortable with is that we've had a long track record of rating CLOs. It goes back well into the kind of late 90s. And I think we're comfortable with two other elements that give us some sense of what we could expect going forward. Because obviously, you could always debate about the degree of leverage you're seeing, whether you're measuring it from debt to EBITDA for underlying leverage loans, or even some of the loan characteristics that have at times been sources of concern for different pockets of people as they look at the covenant light, as they call it, which is really just the question of maintenance covenants versus incurrence tests, which is too much detail to get into in the underlying corporate loans. But I think the real key is CLOs going to set ourselves up for something that really should be worried about the same way some people might talk about CDOs? And I think they're just very different products. The CDOs back then were made up of slivers of, subprime RMBS. They were made up of other types of structured investments that were pooled together. Here we're talking about really investments that are related to specific slices of leverage loans, which are actual companies that you're then pooling together. Secondarily, if I look at some of the systemic risk that doesn't exist either, you're looking at pricing for AAAs that today probably sits somewhere in that LIBOR plus 130 range, I suppose, depending on which deal, which trade. Versus if you were looking at some of the tight spreads pre-crisis, the AAAs might have been as tight as like below LIBOR plus 30. back then. So, some of those vehicles that purchased a lot of that was more CDOs than ABS, a lot of it doesn't exist. That does not mean there is not risk to CLOs, clearly. But I think it's more calibrated to, A, there's been increased levels of credit enhancement all the way up and down the stack, meaning that at the end of the day, the level of enhancement that you would have for a AAA today versus what you would have had pre-crisis is significantly greater. So this plays a role with regards to any sort of downturn in expectations. So I thought that was sort of an important element to share because I think it might be something that people see the potential similarity, but there's quite a few differences.
Sure, and I think at the core of it, I think we're looking at senior secured assets. At the end of the day, securitization is a methodology that has proved itself to fit certain assets. Obviously, in the mortgage market, it's been 30-plus years. I think the reason CLOs have emerged from the crisis and performed reasonably well because at the end of the day, the loans are senior secured loans, and they are bought by hundreds of institutional investors, professional money managers that can pick from more than 1,500 loans, and in each CLO you can have 200 to 300 of those loans. So I think the structure itself has proved itself well, and I think the senior secured loan as an asset class, there's a couple of interesting characteristics. Aside from being senior secured, I think even during the crisis in 2009 and 2010, while there was very high correlation in the real estate market, it didn't really matter if you owned a house in Las Vegas or Arizona or Florida or New York. It was a different picture in US corporates, for instance. I think the correlation was still, obviously it was elevated, there was more financial stress, but since you have 25 to 30 industries, I think the correlation still remained relatively low compared to the correlation within the real estate market. So I think the keys are diversity of industries and then also diversity of the individual companies within those industries, and having professional money managers that pick those credits and monitor those credits. And another key fact, I think, these vehicles typically have 4 to 5 years of reinvestment period. So an asset manager can actively trade that pool and replace the loans if they see some stress in individual loans, and that's what they're getting paid for. So I think it is a dynamic pool as opposed to a static pool for investors. So I think there is an ability to correct it. Now the key question is, I think for us, and maybe my colleagues can opine, is the leverage at this point too high? Where are we in the cycle? And I can tell you from our perspective, obviously there was a lot of growth. We still see only 2 to 3% default across the CLOs. Those vehicles, at least for when it comes to the debt, are meant to sustain probably at least 2 to 3 times that level of stress. So as long as, from my perspective, as long as rates are still relatively low, that means companies are not paying too high of an interest. It's hard to default if you pay very low rates, even if the company is highly levered, and as long as there's some growth in the U.S., even if it's moderate growth, I think the CLO structures are sustainable.
Yeah, thank you. It's very insightful. As many of you know, that actually we are broadcasting today's conference online. So I think there may be some investors in Asia who are watching this. And again, RMBS and CLOs are the two somewhat popular products for the Asian investors and some in China. So I hope that this discussion is useful to you. But let me, I think we have about 10 minutes left, and let's switch our gears to talk about Chinese market. So we're talking about US products exporting to Asia, and let's see if the Chinese products can be imported to the US or the other parts of the globe. So one chart I want to show is that in terms of how securitization has played a role in funding consumers globally. And we had some charts on Europe, and we really haven't talked about it. This chart shows you the kind of share of funding for consumers, supporting consumer finance in the US and Europe, and clearly US has stood out. But if you look at countries in Europe, there are a lot of variations. And the reason that I put this chart here is that we actually have received some questions from regulators in China about how fast and how much China should see the securitization market grow, because I think there are some concerns about overgrowth in China. So they are looking for benchmarks referenced in the international market. So this is a chart that may be interesting. But okay, so that's the growth in the Chinese securitization market. You can see it's been very phenomenal. Especially, it's almost like linear, a straight line going up. And you can see there are three platforms. The green one is the so-called credit asset securitization. These are bank originated securitization products. And the blue, the light blue one are those called so-called enterprise ABS or asset-specific plan. Those are regulated by China Securitization Zhengjianhui, China Securitization Regulatory Commission. And ABN is sponsored or regulated by the association. So you can see that especially the fast growth in the enterprise ABS, those are financial leasings and so on. And within the securitization market, you can see a somewhat different mix. This is the securitization as a share of total bond market issuance. And as I mentioned earlier, that China's bond market is also close to 45 trillion RMB. It's about 7 or 8 trillion US dollars, so it's comparable to US market. But the securitization as a share of the China's bond market issuance is being tiny. It's single digits. So relative to the US, it's much smaller. So the question is, should China allow, from a regulator standpoint, should allow to grow even more? I'm not going to go. So in terms of securitization market, in China, that has also shifted from traditional bank-sponsored products like CLOs. We talk about CLOs in the US, but these CLOs in China are very different to more RMBS and consumer-oriented product. So I'm going to pause here and ask Raymond to help us to understand what's happening in the market in China and what's driving it. What are the risks that we should, for international investors, what they should look for and focus on?
Okay, that's a big topic. As Jen said very well, and the Chinese securitization market is small in the capital market. Compared to the GDP, it's tiny. And on the other hand, both the government, the markets, and everybody want this securitization, because securitization is a proven financial technology that really is needed in China. But the driving force as China is an emerging economy is still on the financing side. So people are still hoping to using securitization as an alternative financing channel to get funds that they cannot get from the banks. And the capital market is less developed. And so even though it's exponentially developing in the last couple of years, and I think there's still a big room for growth. Now, what is the impedance? I think if you ask different people, people will tell you different things. Just like you ask a couple of blind people, what's the elephant look like? But there's a few key points that is related to either the political economic system in China and also the stage of economic development in China. One is, of course, is the legal system. And in China, as we all know, the securitization has to be built on a foundation of rule of law. In China, the issuers, when investors looking at the issues, the investors are still highly dependent on who the issuers are instead of what the assets are. And there are problems coming from the investor side because China also lacks institutional investors, especially when you go down to the credit spectrum. Now, when I look at if we go back a little bit, we think about the securitization. If you look at vertically, the chain from origination, the assets, and from structuring, pricing, and the trading, distribution, and post-issuance, you have asset servicing, and you have a secondary market. If you look at this chain, value chain, but you also look at the horizontal, this is vertically, you from senior, mezzanine, junior, if you all look at these things, China, I call it a capital market structure. This capital market structure in China is not established. So it cannot accommodate the securitization needs from the financing side, capital users. So we see a lot of missing parts in China. So that's one of the reasons the legal infrastructure are still not ready for pass the credit risks to the markets. Now, the second, I think, impedance is a lack of professional investors on the buy side. In China, you can see the money is more like a bipolar. Either you have money from the government-backed entities who are risk-averse, who only want triple A's and liquid market, or you have PE monies, you have retail monies who are not really understanding the balance, the trade-off between the risk and the rewards in the fixed income spectrum. But in order to accomplish a full, complete securitization, you have to have investors from all capital structures, which is missing. And there's also a term mismatch because a lot of financings, you have a long duration. Because of the money nature of China, you only have short money. You have short-term money. And the long-term senior money from insurance company are still heavily limited, regulated to get into the securitization markets. And we don't have those structured product investors like in the US can go down to the credit structure spectrum, get a mezzanine or the junior bonds. And so you have this kind of mismatch. And then, of course, you can see even the market's exponentially grows, the secondary market is still not there yet. So we only have a securitization is more like people, a lot of institutional investors from bank investors, they hold those assets through maturity. That's also one reason they don't want to hold the long-term bonds. Now, if you look at the number, very easy. I cannot see this because my eyes. And the outstanding market as the end of last year, I think it's 3 trillion renminbi, and less than 3 trillion. The issuance last year was about 2 trillion. So if you just do the math, the average duration of the Chinese securitization bond is only 1.5 years. It's more like a money market kind of a product. So that's why, the other side, in Chinese, we also call it crisis and Wei and Ji, right? That's actually give international investors a tremendous investment opportunities if you want to go to China. Because like in the US, whenever if we are a buy-side investor, a hedge fund, we always think about if we find a dislocation in the credit spectrum, that's huge opportunity. Everybody jumping, create a hedge fund and doing this. In China, if you look at the securitized markets, structured finance market, everywhere is the structured dislocation. Okay, you can go there, you can find all opportunities. But in order to profit from that dislocation, that takes work. And I don't want to get involved with that. So, that's a long answer to your question.
Thank you. So any other thoughts in terms of like what international investors actually are seeing the product in China? Do you like it? You find it attractive?
If you look at the Chinese market, look at it, out of those trillion things, 50% of the asset class, it's just two classes, RMBS from big banks and accounts receivables. Accounts receivable, all kinds of accounts receivable from corporates. And there's all other kind of many different assets. But some of the assets that are emerging are very interesting and probably very appealing to foreign investors are consumer financing. Auto loans and financing costs. Of course, we recently have some pullback from P2Ps, things like that. But I think the consumer financing probably is going to be the, in addition to the RMBS, is going to be the first asset class that will be accepted by Western investors.
Yeah, so Stephen or Winston, do you see international investors actually are really interested in those products in China?
I would say, the interest at this point is in its early stages. I think the big issue is we just don't have a lot of RMB capital that's trying to, get itself put to work, and that's really where the interest either begins or ends. So for us, we're not seeing a lot.
When we're looking at some of the data, Bond Connect is a method by which you can gain access to it. There's still a very small percentage, I think less than 1%, of the outstandings are attributable directly to foreign investors. And the vast majority of them are really located in either Hong Kong or in the Asia-Pacific area. I think there's a longer-term, both educational opportunity as well as the fact that in some of these cases, as investors look, especially coming from areas where there's longer track records, there's probably an operating performance challenge a little bit to understanding the data. Is there enough data to get comfortable with it? Secondarily, are there, in the legal system, not just the legal system alone, but also to the extent that if you're going to have to work something out, what does that look like? As well as probably the information flow. Are you going to get the level of information that you want or are comfortable with or standardized to some sense, as well as probably a bit of a language barrier to make sure that you're getting it in a way you can consume it from a U.S. perspective, let's say. So I think some of these things all add up, but I think there's still a bit of a sense that people are interested in learning more. The size and growth, it's hard to ignore, I sense, and therefore I think more people are trying to figure out how do you do that over the next few years.
Thank you. I'm going to try to wrap up 30 seconds each. A question for each of you. Will structured finance product contribute to the next downturn in the U.S. or in China, whichever market you want to pick? Last time it was the structured finance product that had contributed to the Great Recession. Will the next recession in the U.S. or in China will be contributed or led by the securitization products?
I'd say no. Even though there's a lot of discussion about CLOs, it's going to be the economy that's going to be the driver. And it's not going to be, if there is one, it's not going to be driven by the financial system. That would be my intuition at this point.
Yeah, I would probably say no. I think it's going to be more of a function of macro events and rates policy of the Fed and the dynamic changes in the economy. I think structured products is just a derivative of these underlyings.
I think the securitized product, structured financing, in China should be a stabilizer of the Chinese economy. And I don't think it will be a cause for the next crisis in China, rather the other way around. If the securitization markets is not developed at par with the Chinese GDP, that's going to create a more systematic risks.
Yeah, I would probably put it as, and I'm always going to hedge my bets a little, highly unlikely. However, there are pockets of risk that have to be monitored, and I think CLOs, leveraged loans, are always top of mind for us in our institution, and I know with other people as well, that's something you monitor. But I sense that overall, there's a question of whether it's just going to be right-sized in the event of a downturn, and I think that's where we're generally feeling pretty good based on all of our stress testing.
Thank you very much. Please join me in giving them a big round of applause, thanking them for their great insights.